Hi everybody, my name is Miro Svoboda. In today's video, we'll talk about how to protect your wealth and how to protect your nest egg during a recession, or how to bulletproof your portfolio for a recession. As we all know, markets are cyclical and markets go through various cycles. And the reason for that is that also economy is cyclical. And generally when the economy is going through a recession, the overall market pulls back as well. And the effect is that your personal net worth declines as well. The value of your portfolio, the value of a traditional portfolio generally will decline during a recession, and your overall net worth, your nest egg, your retirement assets, everything declines during a recession. And this is a problem. This is a problem especially if you are transitioning into retirement, or if you're already retired and you're pulling income out of your retirement savings. But you could argue that any time during your lifetime when your net worth is being reduced, when you're losing money, it's always a problem. So let's look at a hypothetical example, and let's assume that during a recession or during a market pullback, your portfolio, your retirement nest egg, will lose about 20% of its value. So in this example, we're looking at a portfolio market value of 1,000. If you lose 20% year one or year two, you would be down to $800. Now, the TSX returns on average about 12%. So as you can see, it's going to take you 2 years to recover the loss that you have suffered in year one. And by year five, the value of your portfolio will be $1,258. The average return of this particular portfolio, of this assumed portfolio over those 5 years was 5.6%. Now, if you were able to avoid the 20% pullback during a recession in year one, your 5-year average return goes up to 9.6%. Now, the reason we chose 5 years is because statistically, markets actually go up 80% of the time. So markets are positive 80% of the time, but it also means that 20% of the time, the market will go the other way. So market goes down 20% of the time. And it is extremely important to protect your portfolio during what we call a bear market, when market is losing value. If we can protect your portfolio when market is going the other way, then on recovery, your average return will be that much better. How do we do this? Well, in a traditional portfolio, traditional retail portfolios through your bank or through your advisor, most investors unfortunately only have exposure to stocks and bonds. On the other hand, pension funds and private institutions have been diversifying their portfolios into private securities. So as soon as you have exposure to private securities, not just public securities, and private securities are securities that are not correlated to stocks and bonds. So when stocks go down, private securities generally hold their value. The bottom line is that if your portfolio has only exposure to stocks and bonds, only to public securities, so mutual funds, ETFs, and so on, you can expect that your portfolio will be down about 20% on average every 5 years. Now, how do we avoid this? In order to avoid this, you need to have exposure to assets, to securities that are not correlated to stocks and bonds. And these are generally private securities. We're talking about private mortgages, we're talking about private rental real estate, and possibly private equity. Now, if you currently do not have any private securities in your portfolio, you need to contact an independent advisor in order to get access to these private securities. The other problem that is caused by recessions and the fact that market is very cyclical is that if all of your portfolio is down, if all of your assets are correlated, if all of your portfolio is down, and you need to pull income, or you need income because you're already in retirement, or you need to sell part of your portfolio in order to draw funds out, what are you going to sell? So the problem is a high correlation, and correlation just means that when assets are highly correlated, they move in the same direction at the same time. So the other advantage of having exposure to private securities in your portfolio is that, as I mentioned earlier, private securities have very low correlation to stock stocks and bonds, and also private securities offer predictable returns. So not only will private securities protect your portfolio during a recession or during a market pullback, but will also provide predictable returns and predictable income stream in retirement. Thanks everybody. Please like the channel, please subscribe to the channel. There is a video specifically on private securities and other videos on wealth planning. Right up there, the link is right up here. And we will be releasing new videos on a weekly basis. Thanks again, have a great day. Bye everybody.